Hi, my name is Nusratul Ashira binti Ali, and today we will talk about why company matters and how looking at it help us make smart choices like where to invest. So, companies share financial reports, and these are really important, and lots of people use them like investor, banks, managers, and even government group. We use those like comparing numbers or looking at trends to understand this report, and the main goal is to help people decide where to put their money and plan for the future. So let's meet the companies we're looking at today, and we will learn a bit about them and what they do and who their rivals are. So for company 1 is Xinhua Holding Berhad. So firstly, Xinhua Holding been on the stock market since 2015, and they mainly move goods by lands, which is 18% of their business, and they also do warehousing and e-commerce delivery. They even started making small parts for machines, and for good news, their sales grew by 36% recently, and they lost less money than before. Next is Tiongnan Logistics. They're an older company, started in 1975. They work all over Southeast Asia and have over 1,500 trucks. They also build properties and housing for workers, and they're a big company with good revenue, profit, and lots of assets. So next is, what is Xinhua does? Xinhua main works involve moving things by truck, storing goods, and making precision parts. They also make and sell trailers. They help with online shopping deliveries and also logistics. Overall, they offer full logistics services in Malaysia and Singapore and also Indonesia. So now we're talking about Tiongnan Logistics. So what Tiongnan does? Tiongnan handles all sorts of logistics like freight, heavy transport, and cross-border trucking. They have advanced warehouses like those with robots. They also expanded into property worker dorms and also investing. They are focusing on using technology and growing in the region. Now, let's look into Xinhua competitors. So, Xinhua competes with other big names. The first one is CJ Century Logistics. They are strong in tech and online shopping logistics. Next, we have Tasco Berhad. Tasco good at cold storage and also international shipping. Other than that, Post Logistics also have many trucks and deliver to far off places. Now we're looking at Tiongnan. Tiongnan also has tough competitors. The first one we have is GDEX. This one expert in courier services and online order fulfillment. And we have FM Global Logistics, strong in Southeast Asian shipping and also custom. Other one we have is Swift Haulage, a leader in moving shipping containers and also digital logistics. Now let's take a look for the SWOT analysis for Xinhua company. So for the first one is strength. So Xinhua has been around since 1965 and is well trusted in the industry. They also own their own warehouses and trucks, which help reduce costs and manage delivery better. And they also offer many logistics services all on one platform like trucking, warehousing, and also distribution. Now let's move to the weakness for this company. However, the company only operates in Malaysia and Singapore, which limits its growth, and they also face high costs from fuel, vehicle repair, and also staffing. Another issue is that they rely too much on just for a few big clients. Now we move to the opportunities for this company. So there are some good opportunities too. E-commerce is growing fast, which means more delivery demand. Xinhua can expand into new markets like Indonesia and Vietnam. Using new technology and electric vehicles could also improve efficiency and attract eco-friendly clients. Next we have is threats. The logistic industry is very competitive. Fuel prices and the economy can affect their costs and profits. If they don't keep up with new technology, other companies might take the lead. So to sum up, Xinhua has strong experience and good services but needs to expand and innovate to stay ahead. Now, let's move to the SWOT analysis of Tiongnan company. So, for the strength, Tiongnan has been in the business since 1975 and they offer a wide range of services and on many trucks and warehouses. They also operate in Malaysia, Singapore, Thailand, and Vietnam and use smart warehouse tech to boost service quality. Next, we move to the weaknesses. But Tiongnan also face high fuel and staff costs. The company has a lot of debt which affect its finances, and it also struggles to keep up with the fast-changing technology. Now we move to the opportunities. There are big chances to grow. Online shopping is growing, which increases delivery demand, and they can expand more in the Southeast Asia. Using real-time tracking and eco-friendly vehicle can help improve their brand. Now we're moving on to the threats for this company. Tiongnan face strong competition locally and also globally. Fuel prices, new regulation, and economic problems can raise costs. Delays in meeting customer needs or supply chain issue could cause them to lose their business. So in short, Tiongnam has strong services and regional reach but needs to manage its debts and stay updated with technology to stay competitive.
Hello, madam. My name is Mithiran. So today I'll be presenting time series analysis of Tiongnam's financial performance for the years 2023 and 2024. So the analysis mainly focuses on four key areas: liquidity, asset management, leverage, and profitability. So first slide is all about liquidity ratio. So liquidity ratio can be further divided into two parts, which is current ratio and quick ratio. So current ratio, okay, current ratio in 2023 for the Tiongnam company is 0.72, which further dropped to zero point 0.6 in 2024. So the current ratio measures a company's ability to pay its short-term obligations using its current assets. So this downward trend shows that the company's short-term financial strength has weakened over the year. So this the decline could be due to multiple reasons, one of them being rising current liabilities or a drop in current assets, which may lead to a tighter liquidity. So the second part is about quick ratio. So the quick ratio went down slightly from 0.48 in 2023 to 0.43 in 2024. So this ratio is similar to the current ratio, but it excludes inventory and focuses only on the most liquid assets like cash and receivables. So the lower figures suggest that the company is becoming less capable of covering immediate liabilities without depending on inventory. So this might be caused by falling liquid assets or increasing short-term debt, signaling a need for better cash management. So the second slide is about asset management ratio. So asset management ratio can be divided further into four parts. The first one is about inventory turnover. So inventory turnover tells us how many times inventory is sold and replaced during the year. So higher number means much efficient inventory management. So in 2023, it was recorded as 4.44, whereas the 2024 it was 5.57. So the increase shows that Tionglam has been moving its stock faster in 2024, which is a positive sign for the company itself. So the improvement may be driven by stronger sales or more effective inventory management and control. So the next part is about receivable turnovers. So receivable turnovers uh, is a measure that shows how many times in a year the company collects its average account receivable. So receivable turnover rose from 3.03 in 2023 to 3.19 in 2024. So the slight increase suggests that Tionglam is doing a bit better at collecting money from customers. So this could be due to improved credit policies or customers paying promptly, though there's still room for improvement. So um, average collection period. So the average collection period tell us how long it takes an average for the company to collect payments from its customers. So the 2020, in 2023, Tiongnom's average collection period was 120 days, under 20 days, whereas the in 2024 it was 114.38 days. So even though the number improved a bit, both years are still far above the industry's norm or the standard industry level, which is 30 to 60 days. So this long collection time may point to relaxed credit terms or um, weak collection efforts, which can affect the company's cash flow in the long term. So the last part in asset management ratio is total asset turnover. So Tiongnom's total asset turnover decreased from 0.28 in 2023 to 0.25 in 2024. So total asset turnover measures how efficiently the company uses its total assets to generate revenue in favor for the company itself. So the drop means the company has become slightly less effective at turning its assets into sales. So this could be due to underutilized resources or slower sales growth, and also which may hurt overall productivity. So the next is third measure, which is leverage ratio. So in leverage ratio, we do have two additional part: debt ratio and time interest earned. So debt ratio shows that a portion of the company's assets are financed by debt rather than equity. So Tiongnom's debt ratio increased from 0.65 in 2023 to 0.68 in 2024. So the rise means that the company is relying heavily on borrowed funds to run its business. This might be due to taking more loans for the company's production or not growing equity fast enough, which increases the financial risk. So the next part is about time interest earned. So this measures how well the company can cover its interest expenses with its earnings before interest and tax. So the time interest earned ratio went up from 1.03 in 2023 to 1.12 in 2024. Um, while there's a slight improvement, both years are still far below the ideal level or the industrial level, which is at it should be at least more than three. But in this case, both of them are less than three. So this low coverage suggests that the company is still vulnerable to rising interest rates or unstable earnings. Mm, okay, the next one is about is the last measure, which is profitability ratio. So under profitability ratio, we do have five subsection. The first one is about gross profit margin. Gross profit margin. So the gross profit margin declined from 17% in 2023 to 15% in 2024, as shown in the bar chart the slides. So this ratio shows that the percentage of revenue left after subtracting the cost of goods sold, reflecting the probability of core operations. So this declines from 17% to 15% over 1 year means the company is making less profit from each dollar of sales. This could be caused by higher cost of materials, higher production, or increased price competition, which reduces their margin overall for the whole year. So net profit margin. So net profit margin tells us how much of the company's revenue remains as net profit after all expenses are deducted from the revenue itself. So net profit margin fell sharply from 14% in 2023 to 7.8% in 2024. So the significant drop suggests that the probability has weakened overall. So this could be due to rising expenses, falling revenue, or both, and is likely to concern investors to invest their money into the company in the long term. So operating profit margin. So operating profit margin um, is a ratio that measures how much profit is generated from core business operations before its interest and taxes. So operating profit margin in 2023 was 6.6%, whereas in 2024 was 9.7%. So the increase indicates that the company is becoming more efficient in its day-to-day activities. So this may result from better cost of control or most effective revenue generation, which is a positive sign despite lower net profit. So return on its asset. Next slide is about return on asset and also return on equity. So the return on asset tell us how efficiently the company is using its assets to generate profit. So it declined from 3.88% in 2023 sharply to almost 1.98%, which is almost 2% in 2024. So the lower percentage shows that Jeonnam was less productive with its assets in 2024. So this might be due to falling profits or asset growth that didn't lead to more income. So the last part in this analysis in profitability ratio is return on equity. So return on equity is a ratio that measures the return generated for shareholders based on equity they have invested. So ROE is also return on equity dropped significantly from 11.2% in 2023 to 6.18% in 2024. So the decline shows that the company is providing lower returns to its investors. So this could be because of lower profits or an increase in equity that's not being used efficiently. So this might lead to this might lead to decrease in satisfaction of the investors in the long term, um, which may decrease the confidence of investors to invest their profits or invest their capital back into the company in long term. So, in summary, while Gyeongnam showed improvements in some operational areas like inventory turnover and operating margin, There are some concerns with liquidity, profitability, and high debt levels. So the company should focus on boosting profitability, strengthening liquidity, and managing debt to improve overall financial health. That's all from my part. Thank you.
So let's move on to time series analysis of Xinhua, which is part of liquidity ratio, current ratio, and quick ratio. The current ratio dropped from 1.04 to 0.6. This means the company only has 60 cents in current assets for every 1 ringgit it owns. The quick ratio also fell from 0.9 to 0.55, which shows an even weaker position when inventory is excluded. Why this happened? Because current assets dropped from 64.70 million ringgit to 46.94 million ringgit, and at the same time, current liabilities went up to 77.8 million ringgit. This may mean the company used its cash for investment or to pay off debts, while also borrowing more in the short term. So overall, Xinhua is now more at risk if unexpected expenses come up. Now, let's look at how will Xinhua use its resource in 2024. The inventory turnover more than doubled from 10.68 to 24.27 times. This means the company sold its inventory much faster, which helps reduce storage costs and waste. The average collection period improved from 88.47 days to 88.47 days to 73.36 days. So customers are paying about 15 days faster, which is great for cash flow. Also, the receivable turnover went up from 4.13 to 4.98 times, showing that collection of payments got better. So, these are all positive signs of improved management. However, not everything improved. The total asset turnover slightly decreased from 0.31 to 0.28 times. This means the company is not making more sales from its total assets, maybe because new investment haven't paid off yet. So for the conclusion for this, Xinhua liquidity has weak, which is a concern and should be fixed soon. But the company made a good progress in managing inventory and customer payments. Moving forward, management should focus on improving liquidity and making sure assets are used efficiently to generate more sales. So let's move on to the asset management ratio, which is in the part inventory turnover and receivable turnover. In 2023, the inventory turnover was 10.68 times. In 2024, it increased sharply to 24.27 times. This is a strong improvement. It means the company sold and replaced its inventory more often in 2024. A higher turnover ratio is a good sign because it shows better stock management. It helps reduce storage costs and it lowers the risk of goods becoming outdated or spoiled. Why did this happen? Because COGS, which is cost of goods sold, increased, while average inventory decreased in 2024. This could mean the company has stronger sales or optimize its inventory control purchasing process. So overall, 2024 outperformed 2023 in inventory turnover, showing better operational efficiency. So next, we look at total asset turnover. In 2023, it was 0.31 times. In 2024, it dropped slightly to 0.28 times. This ratio tells us how well the company used its total asset to generate sales. A lower ratio in 2024 means the company earns less revenue per ringgit of assets than in 2023. This may have happened because assets increase faster than sales, or some assets were underused or not fully productive. It suggests that the company could improve how it manages and utilize its resource. So, in terms of assets efficiency, 2023 performed slightly better than 2024. To sum up, inventory turnover improved a lot in 2024, which is a great for efficiency. But total asset turnover dropped slightly, showing room for improvement in asset management. The company should continue improving inventory control and also review how assets are being used to increase revenue. So let's move on to the part of asset management ratio, which is average collection period. In 2023, it took about 88.47 days. In 2024, it's improved to 73.36 days. This is a great improvement because it means the company is getting paid faster. Faster collections help improve cash flow and reduce the risk of cash shortage. So now look at the receivables turnover ratio. In 2023, it was 4.13 times. In 2024, it's increased to 4.98 times. This means the company was able to collect its receivable more often during the year. A higher turnover ratio is a positive sign because it shows the customer are paying more quickly. It could also mean the company has stricter credit policies or it is doing a better job at collecting payments on time. So in summary, the average collection period decreased, the receivable turnover ratio is increased, and both shows that Xinhua performed better in 2024 when it comes to managing receivables. This helped the company maintain healthy cash flow and reduce the risk of bad debts. So let's move on to asset management ratio in total asset turnover. In 2023, the receivables turnover ratio was 4.13 times. In 2024, it increased to 4.98 times. That's a 20.6% improvement. This ratio shows how often the company collects its account receivable during the year. A higher ratio means the company is collecting money faster and more often. The improvement is very good sign, especially during a time when the company is facing liquidity challenges. Why does this happen? It could be because the company applied better credit checks before selling on credit. It may have used stronger collection strategies, or maybe they offer early payment discounts to customers. They might have also improved invoicing system, helping customer pay faster. So collecting receivable faster is important because it frees up cash that the company can use to pay bills or invest. It reduces the risk of the bad debts and it helps balance out the company's weak liquidity positions. So even though the company had a lower liquidity ratios, this improvement in receivables helps reduce financial pressures. To wrap up, the receivables turnover ratio improved by 20.6%. It shows the company is managing credit and collection more efficiently, and it supports better cash flow, which is especially important right now. So let's move on to leverage ratio in the part of debt ratio and tight interest earned. So we start with the debt ratio. In 2023, it was 0.49. In 2023, it was 0.49. And in 2024, it increases slightly to 0.51. That's a 4.1% increase, meaning that just over half of the company's assets are now financed by debt. This shows a slight increase in financial risk, as the company is relying more on borrower money and less on shareholders' equity. This increase could be due to new debt taken for business growth, purchases, or new projects, or a drop assets value without reducing debt, while 0.51 is still within a normal range, is something that should be monitored carefully, especially with the company's other financial challenges. So now let's look at the tie ratio, which tell us how easily the company can pay interest on its debt. In 2023, the tie ratio was 0.16. In 2024, it's improved slightly to 0.18. That's a 12.5% increase, but both numbers are still very low. A healthy tie ratio is usually above 1.5, and some lenders prefer above 3.0. Anything below 1.0 means the company doesn't earn enough to cover interest from its operating income. So even though there was a small improvement, Xinhua still cannot cover its interest costs, which is a serious concern. When we look at both ratio together, the debt ratio is going up and the tie ratio is still very low. This means the company is taking on more debt but still doesn't have enough earnings to comfortably to pay the interest. This can increase the risk of default and limits the company's ability to make future financial moves. To fix this, management may need to reduce debt, improve operation to boost profits, or find new sources of capital like investor or equity injections. So for overall, the debt ratio shows slightly more reliance on borrowing. The tie ratio, although improved, is still far below safe levels. These trends together show a need for immediate financial attention to avoid long-term problems. Well, let's move on to time series analysis of Xinhua in profitability ratio in the part of gross profit margin, net profit margin, and operating profit margin. So let's begin with the gross profit margin. In 2023, it was 23%. In 2024, it dropped slightly to 22%. That's a 4.3% relative decline. These margins tell us how much profit the company keeps after paying for the cost of goods sold. Even though it's just a 1% drop, it can have a big impact on total profit, especially if sales are high. Possible reasons for this decline: higher input costs, more competitions pushing the price down, or maybe a change in product mix. The company might have also lowered prices on purpose to attract more customers. Management should look into each product line to find out what's causing the pressures. So now let's talk about the net profit margins. In 2023, it was 13%. In 2024, it increased to 15%. That's a 15.4% improvement. It's a great sign. This suggests that even though gross margin dropped a little, the company managed to control other costs very well. This improvement might be due to lower admin or overhead costs, better efficiency in operations, or maybe favorable tax adjustments. This is really important, especially because the company is having liquidity issues. This improvement helps generate more internal cash. So lastly, let's look at the operating profit margin, which show how much profit is left after operating expenses. It was only 1% in both 2023 and 2024. There was no improvement at all. This means most of the company's income is being used just to keep the business running. And possible cause of high admin or selling costs, or not enough revenue to cover expenses. To fix this, the company needs to either cut operating costs or increase revenue to improve daily performance. So for overall, gross margin dropped slightly and needs attention. For net margin, it's improved, a very good sign. For operating margin, stay flat, still weak and needs work. Overall, there are some positive positive signs, but the company still has a lot of work to do to improve core operations and boost long-term profitability. So for last is profitability ratio is part of return on asset and return on equity. So let's start with return on asset, which is ROE. In 2023, ROA was 4.11%. In 2024, it slightly increased to 4.22%. There's a 2.7% improvement. This means the company is a bit better at using its asset to make profit. However, even with its improvement, ROA is still below the 5% target that many industry aim for. So there's still room to do better. Even though the company's asset turnover went down, the net profit margin improved, which helped increase ROE. This shows that cost control and better profit margins are helping the company use its asset more effectively. To improve further, the company should use its asset more efficiently and get rid of underperforming assets or focus on higher margin products. So next, we look at ROE. It increased from 8.05% in 2023 to 8.66% in 2024. That's a 7.6% improvement, a better jump than ROA. ROE shows how much profit the company makes from shareholders' equity. This improvement is a good sign for investors as it shows the company is becoming more profitable from the money invested by owners. This rise in ROE was helped by higher profit margins and also higher debts use more financial leverage. But we should be more carefully while leverage can boost ROE and it also increases financial risk, especially when liquidity is already low. So moving forward, the company should aim improve ROE through the better operations and not just by talking on more debt. So for summarize, ROA and ROE both improved from 2023 and 2024. ROA shows slightly better use of assets. ROE reflects stronger returns to shareholders, but both values are still a bit below ideal levels. So the company is on the right track, but still need to improve efficiency and manage risk for carefully to boost long-term profitability. That's all for me.
Assalamualaikum, madam. My name is Hanis Wazira binti Muhammad Darus. So today I would like to present on cross-sectional analysis 2023 for Tiongnam's and Xinhua company. So for cross-sectional analysis, we have liquidity ratios. In liquidity ratios, we have current ratios and quick ratios. So let's see on current ratio first. The current ratio tells us if a company has enough short-term assets like cash, inventory, and receivables to pay its short-term debts. Xinhua's current ratio is 1.04, which means for every 1 ringgit it owes soon, it has 1.04 ringgit in assets to pay it. This shows Xinhua is in stable positions to meet its immediate obligations. In contrast, Tiongnam's current ratio of 0.72 means it only has 0.72 ringgit for every 1 ringgit it owes, which is risky. It might have trouble paying bills on time, causing cash flows problems. So next is the quick ratio. The quick ratio is even stricter because it ignores inventory, which can take time to sell. Xinhua's quick ratio of 0.90 means it almost has enough cash and receivables to cover its debts without selling inventory. But Tiongnam's 0.48 shows it may struggle more to pay debts quickly and it will increasing their financial risk. So next, let's move to
asset management ratio. In asset management ratio, we have inventory turnover, receivable turnover ratio, as average collection period, and total asset turnover. But for this slide, we will focus on inventory turnover and receivable turnover ratio. So for inventory turnover ratio, it shows how fast a company sells and replaces its stock. Xinhua's ratio of 10.6x means it sells and restock inventory about 11 times a year, which is very efficient. This fast turnover helps reduce storage costs and lowers the chance of stock becoming obsolete. Tiongnam's ratio of 4.44 is much lower, meaning it holds inventory longer, which could lead to higher costs and slow sales. Next is the receivable turnover ratio. The receivable turnover ratio tells us how quickly the company collects money from customers. Xinhua collects money 4.13 times a year, faster than Tiongnam's 3.03 times. This means Xinhua has better control over its cash inflows. So next is average collection period. Average collection period is still in asset management ratio. The average collection period shows the actual days customers takes to pay. For Xinhua, they got paid in about 88 days, while Tiongnam's wait longer at 120 days. Shorter collection periods are better because they improve cash flows. They improve cash flows and letting companies pay their expenses or invest sooner. So lastly, for the asset management ratio, we have total asset turnover ratio. Total asset turnover ratio measures how well a company uses all of its assets to generate sales. Xinhua's total asset turnover ratio is 0.31, means for every 1 ringgit in asset, it's generate 0.31 cents in sales, slightly better than Tiongnam's, which is 0.28. So done for asset management ratio, we move to leverage ratio. In leverage ratio, we have debt ratio and time interest earn ratio. So the debt ratios shows how much of the company's assets are financed by borrowing. Xinhua's debt ratio of 0.49 means almost half of its assets are funded by debt, while Tiongnam's relies more on debts at 0.65. A lower debt ratio is safer because it means less risk from rising interest costs or lower income. For the time interest earn ratio, it tells us if the company's earning can over its interest payments. A time interest earn ratio less than 1 is dangerous because the company doesn't make enough to pay all interest due. Xinhua's time interest earn ratio is 0.16, which is very low, indicating it might face problem paying interest unless it gets money from somewhere else. For Tiongnam's, their time interest earn ratio is just above 1, so it can cover interest, but it's not very strong financially. So lastly, let's move to profitability ratios. In profitability ratios, we have gross profit margin, operating profit margin, net profit margin, returns on assets, and returns on equity. So for this slide, we will explain about gross profit margins, operating profit margin, and net profit margins. So for the gross profit margins, shows how much profit is left after paying direct cost of making products. Xinhua keeps 0.23 cents for every 1 ringgit in sales, which is good. It shows that it controls production costs well or charge higher prices. For Tiongnan, it keeps 0.17 cent, which is lower, meaning it either pays more on to making products or charge less. For the operating profit margins looks at profit after indirect costs like salaries and rent. Tiongnom's is 7%, shows it managed these expenses well, keeping more profit from sales. Xinhua only has a 1% operating margin, which is low, showing it spent more on running the business. For the net profit margin includes all the expenses like tax and interest. Tiongnom's net profit margin is 14, is slightly higher than Xinhua 13%. It shows that Tiongnom handles other costs better or has some extra incomes which improve its overall profit. So lastly, let's see on return on assets and returns on equities for Tiongnom's and Xinhua's company. So for return on assets, it shows how well the company use all its assets to make profit. Xinhua's return on asset is 4.11%, is a little better than Tiongnom's 3.88%, meaning Xinhua earns more profit per ringgit invested in assets. This could be because Xinhua manage its resources more efficiently or spend less on fixed assets. Returns on equity. Returns on equity measures how well the company use shareholders' money to generate profits. Tiongnom has a higher return on asset of 11.2% compared to Xinhua's 8.05%. This means Tiongnom's give better returns to investors, possibly by using more debt or reinvesting profits in a way that grows earning faster. So, to sum up, Xinhua has better liquidity and manage its assets well, but struggles with paying interest and controlling operating costs. Tiongnom has weaker liquidity but control expenses better and gives higher returns to shareholders. Both company needs to improve in different areas to strengthen their financial health. So that's all from me. Thank you.
Hi, my name is Sharifa, and now I will be explaining about the cross-section analysis for 2024. Okay, so let's begin with the liquidity ratio. Okay, so liquidity ratio assesses a company's ability to meet its short-term goals. So the current ratio for both Xinhua and Tiongnom is 60 cents. This means that for every 1 ringgit of current liabilities, each company has 60 cents in current assets available to meet those obligations. Since both companies have the same current ratio, it indicates that they are on equal footing in terms of short-term solvency. Therefore, in this aspect, neither company performs better than the other as they share identical liquidity levels. Okay, so next we consider the quick ratio, which provides a more stringent measure of liquidity by excluding inventory from current assets. So Xinhua has a quick ratio of 0.55, while Tiongnom has a lower ratio of 0.43. This suggests that Xinhua is in a stronger position to pay off its short-term liabilities using only its most liquid assets, such as cash and receivables. As a result, Xinhua demonstrates better immediate liquidity and is more capable of responding to urgent financial obligations. Okay, so moving on to asset management ratio, which measure how effectively a company utilizes its asset to generate sales and manage operations. So the inventory turnover ratio for Xinhua is 24.27 times, significantly higher than Tiongnom's 5.57 times. This indicates that Xinhua is selling and replenishing its inventory more frequently throughout the year, suggesting efficient inventory management and possibly a stronger sales performance. So in contrast, the slower turnover for Tiongnom may point to overstocking or also slower sales.
Hence, in terms of inventory efficiency, Xinhua performs better. The total asset turnover ratio, which evaluates how well a company uses its total assets to generate revenue, is 0.28 times for Xinhua and 0.25 times for Tiongnam. Although the difference is slight, Xinhua is slightly more efficient at utilizing its assets to drive sales. So therefore, Xinhua once again shows a superior performance in this area. Moving on to the average collection period, which represents how many days on average it takes a company to collect payments from its customer. Xinhua's collection period is 73.36 days, while Tiongnam is 114.38 days to collect its receivable. A shorter collection period is generally better as it indicates credit and receivable management. So in this case, Xinhua clearly has better control over its receivables, contributing to improved cash flows. Supporting this receivable turnover ratio, Xinhua turns over its receivable 4.98 times a year, compared to Tiongnam's 3.19 times. This means that Xinhua collects its average receivables more frequently than Tiongnam, pointing again to more efficient credit and also collection practices. Therefore, for both receivable management and efficiency, Xinhua outperforms Tiongnam. Let's move on to leverage ratio. Okay, so leverage ratio reveals how much of the company's assets are financed through debt and how well they can manage debt-related obligation. So the debt ratio for Xinhua is 0.51, while Tiongnam is considerably higher at 0.68. This means that 51% of Xinhua's assets are financed through debt, compared to 68% for Tiongnam. So a lower debt ratio is generally preferred, as it implies lower financial risk and also less dependence on external financing. So Xinhua has a more conservative and healthier capital structure than Tiongnam. So for times interest earned, we can see that Xinhua has a ratio of 0.18 times, which indicates that it is barely able to cover its interest expenses with its earning. So on the other hand, Tiongnam's times interest earned ratio is 1.12 times, so showing that it can comfortably meet its interest obligations. So a higher time interest earned ratio reflects better financial stability in terms of covering debt costs. So in this case, Tiongnam is the better performer, as it has a stronger ability to pay interest on its debt. Moving on to profitability ratio, which measures a company's ability to generate earnings relative to sales, assets, and equity. The gross profit margin for Xinhua stands at 0.22, while Tiongnam records a lower margin of 0.15. This indicates that Xinhua is able to retain 0.22 ringgit from each 1 ringgit of sales after covering the cost of goods sold, compared to only 0.15 for Tiongnam. Therefore, Xinhua has a better gross profit margin, reflecting more efficiency and production and pricing. So for net profit margin, Xinhua records 0.15, while Tiongnam has a net profit margin of 0.08. This means Xinhua earns RM 0.15 in net profit for every 1 ringgit of sales, compared to only RM 0.08 for Tiongnam. The higher net profit margin reflects a stronger profitability after all expenses have been accounted for. So Xinhua demonstrates a better overall profitability based on this metric. Moving on to operating profit margin, which measures profitability from core business operation before interest and taxes, is stronger for Tiongnam at 0.10 compared to a 0.01 for Xinhua. This shows that Tiongnam generates significantly more profit from its core activities. Therefore, Tiongnam has the advantage in operational profitability. Moving on to return on assets, Xinhua records 4.22%, while Tiongnam earns 1.98%. This means that Xinhua is more effective at generating profit from its assets. For return on equity, Xinhua has a higher ROE at 8.66% compared to a 6.18% for Tiongnam. These two ratios indicate that Xinhua delivers better returns both on asset and also shareholders' equity, signifying better overall financial performance from the perspective of investment efficiency.
Here's the main takeaway for the conclusion. Xinhua seems to be doing better than Tiongnam when it comes to money management, using their assets well, controlling debt, and also making profit. Both companies need to work on having enough ready cash, and Tiongnam should try to use its asset better, reduce its debts, and make more profit by cutting costs or growing. For both, running things efficiently and being smart with money or key are for the long-term success. That's all from me. Thank you.